Hi, my name is Joe Goldman. I'm here with Ed Kennedy and Lori Hellkamp. Lori and I work together in the Washington office at Jones Day. Ed's in our New York office. Ed and I are co-leaders of Jones Day's tax practice, which includes lawyers in 20 locations around the world who practice tax. We've Ed and I have worked together on pharma transactions since back in the mid-90s, right, Ed? When Ed was a partner at KPMG and he headed their pharma practice. And Lori is one of our partners. She chairs the ABA Committee for Inbound Investment. She has a lot of deal experience. She lives in the international rules, which are impacted in M&A. You got some snippets from our resumes here. Here's our phone number as well. We'll be sending this to you later, as well as the materials. We welcome your phone calls. We have an hour with you today to discuss major tax issues in pharma transactions and some proposed changes. You are a diverse group, actually. There's some GCs, there's some C-suite, there's some technical tax specialists. What we won't do today is speak to you in code speak. I usually keep a swear jar, and I throw in $10 whenever I slip and mention a section reference. We're going to keep this conceptual and tax practical. The order is I'm going to start by giving some background, then launch into some types of transactions that you see with Ed, and then Lori will close with the description of proposed U.S. tax reform that we've been reading about, following, and what's going on in the OECD and the EU that also impacts transaction. We're going to try to leave some time for questions, or if there are none, we'll use all our time. And in any event, we just urge you, reach out to us directly, call us. We gave you our phone numbers because we do pick up the phone. So we're going to talk about a lot of different types of transactions. You see here, it's everything. It's M&A where you buy a company outright. It's joint ventures, which are often treated as a partnership from a tax standpoint. It's asset transaction like licenses, COCOs, and royalty sales. And it's a large area, but the tax principles are relatively constant and universal. And we're going to use some examples to show what'll happen if you tweak the deal terms a bit. So I promised some background. To understand pharma M&A tax, you have to start by recognizing that for a variety of reasons, U.S. companies hold a lot of IP in foreign subsidiaries. They hold a lot of IP offshore, and obviously multinational parented companies do as well. And one reason for this is because they sent IP offshore, or they acquired IP offshore before the laws changed in 2017. Right? That's how you all know how the cash tax rate of pharma companies has always been low. It's always been in the low 20s, despite a U.S. corporate statutory rate of 35% for years and years. And smart tax planning had U.S. pharma companies sell their early stage IP to foreign subsidiaries, and they'd soak up NOLs to avoid a cash tax, and the foreign subs would develop the IP and earn profits offshore, taxed at low rates. There'd be intercompany transactions, but at the end of the day, there was income, cash, that was offshore. And that wasn't taxed until it was distributed. So what happened? It was never distributed, and tax deferral was indefinite. And the end result was a 35% tax, but on a smaller share of income earned by the U.S. parent, and a U.S. tax, and a lower foreign tax on the earnings of the foreign sub, which was good for a tax lawyer, but not ideal for a company, because you're building up foreign cash offshore. It meant the parent had to borrow to fund the U.S. operations, or to fund M&A, or the foreign sub had to make the M&A purchases, and you end up with a clunky inverted structure of U.S. on top of foreign on top of U.S. And there were landmines in the tax code that would tax U.S. multinationals on passive income, on credit support. So despite a low cash tax rate, the U.S. parented pharma multinationals were at a disadvantage. This was widely reported in the news. Inversions were widely reported. 2007, this slide here, it was the paradigm shift. And one of the goals of tax reform in 17 was to stop companies from selling their IP, sending their IP offshore. And And honestly, in a lot of cases, they achieved the goal. And some of the tax changes enticed companies back to the U.S. Others were sticks that beat us back to the U.S. But all of the changes impacted M&A structure. Picture does is it kind of shows you the two biggest incentives in 17 were they lowered the U.S. corporate rate and they made dividends cheaper. This is the picture that shows exactly how that happened. They made most of the foreign dividends tax-free because they imposed a one-time repatriation tax on all of the trillions that were in foreign earnings accumulated in the foreign subs, and they gave an exemption for foreign future dividends. What did that do? That frees up cash to make investments from the U.S. As far as the lower rate, you see here, the corporate rate dropped 14 points to 21%. The rate on export sales dropped 22 points to 13%, right? When you're selling from a U.S. company to a foreign purchaser. So that obviously gives you less bang for the buck on planning. And then there were sticks that beat us onshore. They took away the allure of a low tax on foreign subsidiaries by introducing what they call GILTI. That's shown to the bottom, the red circles in the bottom. A new U.S. tax on shareholders of 10.5% up from 0 on the foreign subs IP earnings, which was essentially all earnings in excess of a very small tangible asset return. And on top of that, you're operating in a foreign subsidiary that's taxed in a foreign country. Foreign taxes on the earnings were only partially creditable, so there was a partial double tax. And the end result was about a 13% total tax on foreign sub-earnings in most low-taxed countries where the IP was going, which wasn't much lower than the U.S. corporate tax on export. So really the question, why go offshore, was asked. So that was one of the consequences of tax reform. And they also beat us up with, you see in the middle, this 10% US AMT, a new 10% alternative minimum tax on large taxpayers called BEAT, Base Erosion Anti-Abuse Tax. You know, I said the corporate tax rate is a low 21%. The alternative corporate tax rate, this BEAT, is a lower 10%, but it's on a higher taxable income. It takes the net income and it adds back large deductible expenses paid by large multinationals to foreign related parties. And those of you who are subject to it know that that captures a U.S. parent paying a foreign sub for services if it's big enough and the payments are big enough. It's non-deductible from a BEAT. So that's another beat, like why go offshore? And then they beat us up with there was a new NOL limitation. You used to be able to carry forward NOLs from an earlier year and eliminate your income. Now the carryover is limited to 80%. Okay, now that's a big deal. If you have NOLs of like 100 from year one, year two you have 100 of income, you can no longer, taxable income doesn't net to 0 in year two, it's 20, right? 80% of 100, so you end up with a 4.2% minimum tax. And then they beat us up by forcing us to capitalize R&D. And so you got like 4 negative factors, right? If you want to move off IP offshore, you got a higher exit tax because of the NOL limitation. You've got more operating tax being onshore because of the minimum GILTI, because of BEAT capitalization. And all this is happening when the corporate tax rate's almost as low as GILTI. So less bang, I'm being repetitive, but it's less bang for your buck. So of course this changed pharma M&A. It made some easier because you had a bunch of cash that was previously trapped. It made some harder. A lot of your, go back one slide, Ed, would you? A lot of your IP is offshore, so you have to deal with GILTI. You got a cash tax on your foreign earnings where it previously were. And so a lot of the old structures had to be revisited. So both foreign IP sales became more complicated by GILTI, and foreign and U.S. IP sales became more complicated by GILTI and NOL restrictions and R&D capitalization. And R&D capitalization is a big deal. Spoiler alert, I'm not going to take away Lori's thunder, but Lori will be telling you about the reconciliation bill being debated in the Senate, which proposes some changes to the capitalization rules that would make some of these rules more favorable and some changes that would make guilty more unfavorable. So stay on till the end. You'll hear Laurie. So with this background, sorry for the quick summary. We begin with asset transactions. Okay, let's move it on. Asset transactions are unique. They're unique because the payor, the licensee or the buyer, can get a tax benefit by deducting payments or amortizing purchase price. Okay, and they're the most, as you all know, they're the most common IP transaction in life science, right? In a typical situation, you have a development stage life science company that exclusively licenses or sells IP rights to someone else, often an unrelated, mature life science company, in exchange for upfront fees or profit share and milestones and royalties and equity. You got hundreds of pages of agreements that allocate rights and responsibilities between the parties for everything you can imagine: development, clinical, regulatory, manufacturing, you name it. Now, there are a lot of names for these documents: collaboration, license, alliance, COCO, royalty sale. But what's common to all of them is these upfront payments, these milestone payments, these sales-based royalties. And there are 5, what do the tax lawyers worry about? These are our 5 main things we worry about. They're not always a problem. Sometimes none of them are a problem, but they're always on our list. They are, first of all, is this a partnership? Okay, you're sharing expenses, you're splitting income. Spend some time worrying about this. Is it a sale or license for tax purposes? Okay, different tax consequences, even though it might be called a license. Third, does income match deductions? Is the payment taxable income? And if so, is there a matching deduction? Fourth, is there a withholding tax? Does any country require the buyer to withhold taxes? And if so, what do we have to do to avoid it? And then fifth, what's the purchase price allocation? Because often there's different things happening in a transaction and you gotta allocate it between them. Here's our picture. Okay, our first picture. You've got IP and stock coming from a pre-revenue company on the right to what we call a big pharma company on the left in exchange for cash and other promises. Doesn't have to be like this. It could be 2 big pharmas. It could be 2 pre-revenue companies, but kind of like a frequent structure. You got the pre-revenue pharma company signs, let's say, a collaboration agreement to give rights to one of its products to a big pharma company. They get $150 or $150 upfront for the license of the IP. Okay, or they may share the research results and give big pharma a first look to opt in and pay for a license when the IP reaches some critical stage or proof of concept, whatnot. And then the payments that are coming on the other side from the other company are upfront payments for signing the contract, maybe compensating for past research, milestones, and sales-based royalties. And in addition, often in these situations, there's other stuff happening. The pre-revenue company may be issuing stock or options to the big pharma for additional cash. So the first question, we said, is it a partnership? Is this collaboration agreement just a contract, or has it done something from a tax standpoint? Yes, you can have a partnership even without forming a limited partnership if there's shared control and shared profits and losses to a significant enough extent. Details aside, you don't want a partnership to happen by accident because there are different rules, there are different reporting requirements. You file a different tax return. There are different tax accounting methods which allow you to determine how much your deductions are. They'll be made at a partnership level instead of the individual. And it's just a holy mess if it's a cross-border situation, because then you're doing business in multiple countries and you want to avoid an accidental partnership. On the other hand, you may want to create a partnership on purpose, or you may want a contract to be treated as a partnership on purpose. Why? Well, in a partnership, collaboration payments may not be income or expense. It may just be contributions and distributions, which are more likely to be non-taxable, which the pre-revenue pharma company may prefer. So usually, unless it's a COCO where you're sharing profits and losses, which is more likely to be a partnership, collaboration agreements are not partnerships. If it is a partnership, the contract will have lots of tax allocations and elections and distribution sections. Now, I'm going to give another spoiler for Lori. She's more fun to listen to than me. There's proposed legislation. Don't know if it's going to go through or not, making partnership tax treatment on JVs less favorable. Because why? Partners have to agree on income and expense allocation, and there's a Senate proposal. Again, it was from this summer, that would require partners that contribute appreciated IP to use a special remedial allocation method and revalue assets upon a contribution, which means that if a partnership that has no net income could have gross income allocations to the contributing partner, which would be not good. They were proposed with prospective effect, and some companies rushed to their JV formation to get ahead of those rules. But anyway, just on the partnership question, think about it, and that's another, the other variable to think about is what the proposed rules may change about it. Question, let me go back. Question 2, is it a sale or a license? Now, a sale occurs when all substantial rights are transferred. It happens when, for example, a license gives perpetual exclusive rights to the IP forever, and the licensee has control over major decisions, okay? Like all the major decisions. That happens in a lot of situations. A license is every other situation where the licensor retains something significant in the IP. There's a big difference. Sale proceeds are taxed as capital gain. Licenses are taxed as ordinary income. That's a difference because the way your gain is calculated will differ, but it's also a difference because of the different character. It certainly matter to individuals or partnerships where individual partners, because they have a lower capital gain rate. It might matter to a corporation in the rare situation where they have capital losses about to expire. That sometimes happens because you can only carry back for a short period. So sale or license is important. Third question is, does the income match expenses? Okay, here I'm gonna go a little bit deeper. Look at this little blue box. The little blue box on this page shows the pre-revenue companies cash in, how much cash they're getting, license payments and stuff like that, and the cash out, what they're spending on R&D, okay? And in this case, remember I told you they got 150. Let's assume in the years before the collaboration agreement was signed, they lost 100 of NOLs, which carry forward. And in the year of the transaction, they get the 150 as a license fee. And then they spend 50 in the year after in the year of the transaction here, and then in the year after the transaction. So what's the tax treatment? The licensor has spent $200 over a period of years. It's received 150, which is less than that. But in the year of the transaction, it has 100 of net income. It has 100 of net income. It has earlier NOLs, but remember, carry forward rule on the NOLs only makes it 80% deductible. It's not fully deductible. So a pre-revenue company pays taxes despite having NOLs. Now, I was on the phone with somebody yesterday where the C-suite was surprised to hear that result for a transaction that they had already done. So this is something that needs to be confronted on the front end of the transaction. And often there are things you can do to manage the situation. One solution is if a contract is a license, not a sale, see question 2, then the licensor can make a tax election to defer the advanced royalty portion of the upfront payment for 1 year. You know, the upfront IP payment is an advanced royalty. The taxpayer elects to defer it for 1 year. 1 year may be enough to smooth out the income to match the expenses. So that may help or ameliorate the problem. It may not work. It may not work if the payments received in the IP tax transaction is a sale. It's not an advanced royalty, and there are other technical requirements. And it may not get you there entirely because the matching rule is something that really needs to be front of mind in modeling a transaction, because not only because of the NOL carry forward limitation, but because, as I mentioned before, there's new R&D capitalization requirements. You got to, capitalize it over a period of years. You may not be able to expense the R&D anymore So that's a problem for U.S. companies. And then finally, if the pre-revenue company is a foreign company, the matching problem is much worse because the GILTI tax that applies, the minimum tax that applies to the foreign subsidiaries, applies on a year-by-year basis, completely ignores NOLs. So deferral elections are even more key. You gotta model the spreadsheet. Fourth question, withholding tax. First, a U.S. withholding tax. If the licensor is foreign and the IP includes U.S. IP, the U.S. imposes a 30% withholding tax. Wow. On the licensee, the payer, big pharma, big pharma in this case. Unless the licensor is a resident of a treaty company, most treaties, the U.S. has treaties with almost every country. They eliminate the withholding tax, not all of them. You got to get a form. So that's one thing to be on your closing list. The other closing list item, which is a more recent situation, is foreign withholding tax. Foreign withholding tax we never really worried about until recently. The only country where the licensor is subject to where the payment is subject to withholding tax is a country where the licensor is resident. They would withhold a withholding tax. Where the IP is registered didn't really matter outside the U.S. That's changing. For example, many of you may have heard about this situation in Germany, where Germany now requires non-German licensees who license from anybody, from a non-German licensor, to pay a German withholding tax if the IP is registered in Germany. And the only exception is if the licensor provides an exemption certificate obtained from the German government before the payment, asserting that a treaty applies, which is impossible because they just recently discovered that this rule was on their books and recently announced that this is the rule that they're enforcing, but apparently it was the law for years and never enforced. And so the Germans are now requiring companies to review all their transactions in the open statute of limitations, make corrective filings as soon as possible, submit for an exemption certificate late, and follow new procedures going forward. Now, there are exceptions, but they require an analysis of the actual agreement to make sure that the transaction is outside of the rules. But that's another thing that should be on every closing agenda, withholding tax. And then the fifth thing, quickly, purchase price allocation. Remember, I said in our case, the pre-revenue company is also selling stock and options. Stock and options can be issued tax-free. They're almost irresistible in the way of, from a tax planning standpoint, in that they raise cash without worrying about matching expenses. Obviously, tax isn't in a vacuum. There are business issues to consider. Downside of options is maybe board seats, is that you may block competitors from future M&A. But in any event, there's going to be a purchase price allocation. Purchase price allocation negotiations, especially if it's a private company, could be, parties have different interests. The licensor will want a tax, they want a higher they might want a higher allocation. The licensee will want amortizable basis in the IP, and they'll resist the purchase price allocation to a non-depreciable asset. So keep these things in mind for asset transactions. I've talked a lot. Ed, you take it over.
Thank you, Joe. I'm going to talk for about 13 minutes before I turn it over to Lori to do the update on what's going through Congress right now and the effects on pharma. The first slide here is milestone payments, and this is really drilling down a bit more on what Joe talked about. And for years, we didn't worry about milestone payments because generally speaking, we were talking about pre-revenue companies, and we had plenty of NOLs at the U.S. company. So if they received a milestone, the NOLs weren't limited. You may recall in Joe's earlier slide that there's a 4.2% tax if you can't match income and expense in the current year. That's become a real issue just because, I mean, look, you haven't made any money. You get a milestone payment. It's supposed to be there to fund additional research, but you end up with a 4.2% tax to the extent you don't. So if you receive a $100 billion payment, for instance, and you only spend 50 in a year, you've got a $50 million taxable income in that year, and you have to pay 4.2%, even though you have plenty of NOLs in the United States. So we're worried about that, and that's happening across pharma, especially in the pre-revenue space. And the worst situation, quite frankly, is guilty. And here, we show a picture of, a milestone payment going to a foreign company that's a CFC, so a U.S.-based multinational with let's say a Swiss CFC, receives a $100 million payment. And let's assume, again, current year deductions are only $50 million. Again, here is going to be guilty, so you're going to pay a 10.5% tax on that milestone payment. And Joe mentioned earlier that if the milestone payment is a license, so if it is, effectively a situation where you've agreed to license a product, but it doesn't rise to the level of sale, or it's a funding of research, for instance, you're required to spend it on funding. It's basically a mix of prepaid service and license. Then you can take advantage, and I'm going to swear one time, 451 of the code, which allows you to defer for 1 year. Prepaid, intangibles and prepaid services. So we are working with companies to deal with this. But the reason that I'm drilling down on it is because we do have a change coming at 1/1/22, where R&D will be under current law, just because of the scoring that was undertaken in the 2017 reform. We will now be amortizing research over 15 years. So that equation that was 100 billion in with a $50 million deduction in the foreign jurisdiction is 100 billion in and virtually no deduction in the current year, and you end up basically you're paying on the full 100 billion. You got a $10 million tax, and people aren't happy about that. The same thing with the U.S. as well, going to a 5-year amortization on R&D. So the matching of income and expense, and this 4.2%, I'm going to call it a minimum tax, 4.2% NOL usage tax in the U.S. makes this situation a lot worse. So when we are negotiating these deals with milestone payments in order to get the maximum flexibility, we're looking to push these things into license and not sales transactions so that we can get that one year deferral. The good news here is that good and bad. Right now, here, I just described the current state in 2022. The proposals are to basically allow you to continue to expense R&D. I think it's through 2026, and I'll let Lori cover that later. But there is some relief here, but on the downside, we are going to go country by country. So if we have deficits in other jurisdictions, we can't use them to offset the guilty, et cetera. So something to think about. The second transaction I wanted to talk about, and this is, I'm gonna go quickly through this. This is basically, these things are called, it's like Kleenex, it's a brand, but these are called royalty pharma deals, even though they really should just be called a purchase of an income stream or a right. These are interesting transactions because it's generally a pre-revenue pharma. Again, the payment is really there to fund research. Instead of doing an IPO, instead of getting another venture capital round, you go to royalty pharma. They say, hey, we want to buy a vertical slice of your revenue stream, and you will pay us, 3-5% royalties on sales when there's approval for the entire length of the patent life, and so, or even for as long as you sell the drugs, depending on how the agreement is written. On these, we've struggled with what that upfront payment is. Is it a loan? Is it basically just an option to acquire so that we don't have to pick it up in income right away? But I think that most people, most advisors believe that it is income up front because there's no real obligation to pay it back at a particular time, et cetera, et cetera. We could argue that it's a contingent debt instrument, et cetera, but we think it's probably taxable up front. So you have the same matching issues that we talked about on the prior slide, because you're going to be picking up this income up front with no basis offset, but you will be able to to offset it with R&D and things like that. So that's part of it. One of the things that's concerning about existing royalty pharma type deals is that a lot of times the buyer of the intangible in the royalty, or the lender or the funder of the research will be receiving these royalties. The change in law risk on withholding is on the company that has sold the income stream, and effectively will be paying the royalties later. In our agreements, there's a gross up for withholding tax. And so when we look at where those payments are going, if they're going to a treaty jurisdiction, a U.S. treaty jurisdiction or European, it's a good treaty jurisdiction, but it is a special type of company that doesn't actually pay tax on the royalty, and the income is distributed out to the investors in the fund that have invested in that, we may see under Pillar 2 of BEPS some type of withholding tax so that we can get to the minimum 15% tax, et cetera. So it's something to be concerned about with a royalty pharma type deal, depending on how it's negotiated, because the model deal is that if you didn't have withholding on the day you signed the contract, because the payee was able to give you, for instance, let's say a simple U.S. deal, they're able to give you a W-8-BENE, let's say it's Ireland, and there's zero withholding on royalties paid to Ireland under the treaty. It's zero on day one. But if it happens to be an Irish entity that doesn't actually pay tax, it's like considered like a regulated investment company or a mutual fund or Irish 110 company or something like that, then it's not subject to tax. What do you do? And it depends on how countries implement the minimum tax. They might put a withholding tax on it, in which case we're talking about a situation where there's a gross up, and it's a big thing. So it's something we're worried about with royalty pharma type deals. I'm switching over to stock transactions. We said we'd cover M&A, and I just have a few minutes left, but I want to talk about a few things that are concerning right now. Notice 2003-65 allowed companies to use a substantial amount of NOLs, and a lot of pharma deals we find that are stock deals are the purchase of companies right before their drug is approved. And we never worried about NOL limitations before because we had this special 2003-65. And what that did was, let's say we paid $1 billion for a company. The long-term tax exempt rate, I think, is like 1.5%. And so the 382 limitation on the use of those NOLs that we acquired was 1.5% of $1 billion, which isn't very much. And usually these companies have hundreds of millions of dollars of NOLs. But during the first 5 years, we were able to increase that Section 382 limitation by using a wasting asset theory, like for a built-in gain. So we'd look at the $1 billion we spent, we'd say there's $1 billion built-in gain. We'd divide $1 billion by 15, and that amount we would be able to increase the 382 limitation. There are proposed regs in 2019 to eliminate that. So it's something we need to keep an eye on in Pharma and M&A, because that will substantially change our ability to use net operating losses. The next big issue on stock transactions is the ability to do spinoffs with pre-revenue businesses. In 2018, the service announced that they would consider, normally in an active trader business, you got to have gross receipts for the prior 5 years. You got to have at least 2 businesses. They've got to have income. And in the active trader business test for 355, I swore again, which is a spinoff, we have to have revenue for the prior 5 years. You don't have to have that anywhere. I think the IRS has only issued one ruling under this. It was a 2020 ruling. It was kind of interesting. You had two, because you still have to have a business purpose to do the spinoff. And this was interesting because they had 2 models within the pre-revenue business. They basically had a model that they were going to do co-promotion, COCO type things that Joe talked about earlier. And they were going to do that, and that was a separate business. And then they had a regular business I'm going to say they wanted to go all the way with, which is they're going to, build out manufacturing and develop and sell drugs. So they had 2 different business models. So they had a good business purpose for spinning out the COCO business, and that's what they did, which was, a 2020 private letter ruling. I'm going to just cover one other thing that we're seeing a lot of, and that is contingent consideration, these so-called contingent value rights. Contingent value rights are basically kind of an unusual instrument that you can't decide on what the value is. So you go and you buy a company, and let's say you're buying it for $5 billion. And there's some uncertainty as to whether or not the drug will get approved, et cetera, et cetera. And you might also issue some contingent value rights, which are really just an earnout. Effectively, if you get to a certain level, a certain milestone, these contingent value rights pay out. Now, contingent value rights, if you've read any of the public disclosures, they're completely uncertain. I mean, you could look at this contingent value right as under Aerosmith, which was the case that says you look back to the original transaction to figure out the character, and you'd say, okay, well, all this is an installment sale. So I'm going to relate it back to that capital gain transaction. I'm going to treat this as an open transaction, and basically every time we receive a payment, it's going to be capital gain, and there's some interest component depending on how long you went away from the thing. Or if the CVR is a publicly traded CVR, you might look at it and say, that is a closed transaction, and therefore I just have payments under the CVR. And just a payment doesn't involve an exchange, and maybe that's not eligible for capital gain treatment. Maybe it's just a payment under a contract. In addition to that, capital gain on the sale of stock, so long as it's not a U.S. real property holding company, isn't subject to withholding. But a payment under a contract is FDAP. And FDAP means that you might well have withholding. So this is when you're using CVRs, it's a situation where there's a lot of uncertainty. So big pharma who issues a CVR to somebody in one of these transactions, needs to be careful about how that gets characterized. And the IRS hasn't really given us much guidance on these, but they are more and more popular. All right, I'm going to go. This is a disclosure on the CVR, so you can see that I wasn't lying. It is uncertain. This is a typical disclosure. Lori, I'm going to hand this over to you to talk about the what's going on in Congress right now.
Thanks, Ed. As I'm sure everyone is aware, and Joe and Ed alluded to, another round of federal tax legislation is currently winding its way through Congress. And if this passes, it will be the second major package of truly significant reform that we've seen within a 4-year period. So while it's a bit difficult to predict when or even whether it's going to pass or exactly what it's going to look like in its final form, if and when it does become legislation, there's at least a good enough chance that the House passed version or something that looks very like it is going to pass in sometime in the nearish future. So we wanted to dedicate a little bit of time this morning to discussing a handful of at least the key proposals in this legislation that will most directly affect the pharma industry. So on this slide, we've just listed out those key proposals. I'm going to call this our cheat sheet for the tax items most likely to be relevant to pharma and life science companies. Obviously, this package of legislation contains a ton of additional things, many of which will also be relevant to pharma and life science companies, but these are the key tax items contained in at least the current version of the legislation. And many of these will be relevant not only for M&A purposes and some of the things that Ed and Joe were covering, but more broadly. So let's just start ticking through these. Changes to interest deductibility. Here, the legislation is going to be important for two key reasons, both what it includes and what it does not include. And what is in there is an introduction to an entirely new rule, which will impose additional, basically a separately calculated limitation based on relative interest expense and EBITDA of a U.S. company relative to the interest expense and EBITDA of other members of that same company's financial reporting group. And this limitation, to be clear, will apply in conjunction with our already existing interest limitation rules. So you're going to have to calculate both, and whichever is more restrictive is basically the one that's going to apply and will provide the limitation for that year. In good news, however, any disallowed interest under these calculations will be able to be carried forward. So at least all is not lost here. What this legislation does not include, however, is the much sought after relief related to the existing interest limitation that's already in the code. These rules currently limit interest deductions basically to 30% of EBITDA of the US company. Beginning next year, however, that is going to flip to 30% of only EBIT, which will obviously, at least for most companies, be a smaller number, and therefore a smaller amount of deductions are going to be permitted. This switch from EBITDA to EBIT is already baked into existing law and would require legislative action to stop it. So unfortunately, that relief that we were all hoping to see is not contained in this package. These changes really matter, I think, for really self-apparent reasons. To the extent a company has a lot of leverage or more leverage in the US than abroad, interest deductibility is going to take a hit, and it's just going to increase the cost of capital. Just as a fun fact for the day, this, if it passes, will also make the US interest deduction rules some of the most restrictive in the developed world. Okay, the next big ticket item here is we've got some changes to the GILTI regime and the foreign tax credit rules. A lot of these proposed changes in this space are really technical and more in the mechanics of how these items are calculated, some of which are actually really taxpayer favorable, some of which are absolutely not taxpayer favorable. But we're not going to look under the hood here and get into the weeds of each kind of component calculation change. I'm going to focus here on the big ticket items and what we expect will have the most impact overall. Front and center among those key changes will be the requirement to calculate both your GILTI amounts and foreign tax credits on a country by country basis. And Ed alluded to this a little bit before, but this is a fundamental departure from the current system, which generally, of course, permits the offsetting of profits and losses across countries for GILTI purposes, as well as the blending of high tax and low tax rates across countries for foreign tax credit purposes. So under these new examples, for example, if 1 year a US company has a Japanese sub with profits and a German sub with losses, the US company is going to be subject to full tax on those Japanese profits under the GILTI regime without being able to benefit from those German losses, which are essentially trapped and can't be used to offset the GILTI income. That said, it's not all doom and gloom. The next key change is to permit the carryover of GILTI losses and tax credits, which under current law, of course, GILTI losses as well as excess foreign tax credits attributable to GILTI income, they're basically lost at the end of each year. It's a use it or lose it system. Under this new legislation, these amounts could be carried forward and therefore at least provide relief or potentially provide relief in future years. Although again, since we'd now be in a country by country system, that relief would basically be available only in the same country that generated the original loss or the relevant tax credit. The other key change I want to mention under GILTI is going to be the change to the rate. This one also is kind of in the, well, clearly in the unfavorable category from a taxpayer's perspective. The US tax rate imposed on GILTI income will be raised to roughly 15%, and that's up, of course, from the current 10.5%. So our next item, Ed touched on a bit, but this is a silver lining in this legislation. Obviously, very taxpayer favorable. The proposed legislation would delay the requirement to amortize R&D expenses, thereby, extending companies' ability to take immediate deductions for qualifying expenses. And this is going to be extended through 2025. Under current law, as Ed mentioned, this benefit would terminate at the end of the year. So obviously this deferral would be a very, very welcome development. So ticking off to our next item, this will tighten somewhat the availability of the orphan drug tax credit. If the legislation passes, qualified clinical testing expenses would generally be creditable only to the extent related to the first use or indication of an orphan drug. So let me say this another way. Essentially, it would kill this tax credit for all but the first approved orphan use of a new drug. And, unfortunately, this comes on top of the reduction, I guess, 4 years ago in the credit from 50 to 25%. So it's just further diluting this credit. Our next item, the new corporate AMT. Under this legislation, under this proposed legislation, the corporate AMT will come back. But it's going to look very different this time. This time it would be imposed based on book profits of corporations. There are just so many gaps in the legislative text as written, that how exactly this is going to be calculated and implemented is really going to be need to be filled in by regulatory guidance. And honestly, I think we're going to be looking both to the IRS and the AICPA and similar organizations to really understand how to navigate this provision. In general, the new AMT would apply at least only to corporations with financial statement income over 1 billion. So it's not going to be a universally applicable change, but suffice it to say that for those companies that will or may be subject to these new rules, we expect they'll be taking a fresh look at some of their accounting practices and places where there are significant book tax differences. This regime is certainly going to put a lot of pressure on items where there are differences between tax and accounting treatment. And the easy ones that come to mind are stock comp and many of the timing differences, including to the depreciation rules. Okay, next up to bat, this legislation would fix a technical glitch from the 2017 tax reform. As part of TCJA, Congress repealed some technical language in a constructive ownership statute, and as a result, many foreign companies overnight became controlled foreign corporations, or CFCs. And these, of course, are the types of entities that are subject to not insignificant compliance and reporting obligations, and any direct or indirect U.S. shareholders become subject to additional tax. Since most of the folks in the audience today, I think, are affiliated more with U.S. companies, or at least U.S. affiliated, U.S. parented multinationals, this change may not be a huge deal in your book, but it has wreaked absolute havoc for many others, in particular foreign parented multinationals, and in other contexts, particularly when it comes to JVs and certain JV structures, debt issuances, and private equity funding. So anyway, key takeaway here, this legislation will fix this broken language. Next, there are going to be some modifications to the existing BEAT rules. And I know Joe and Ed briefly mentioned the BEAT regime. So this is basically the rules that deny U.S. deductions for certain outbound related party payments. Here again, there are a number of kind of under the hood changes to how this tax, which can be fairly punitive, will be calculated under the proposed legislation. Really, the most important big picture change and thing I want to drive home here is the incredibly taxpayer favorable change, at least for U.S. parented multinationals. BEAT would, under the new rules, essentially be turned off for any payments made to a foreign affiliate that's a CFC and therefore already subject to the GILTI and Subpart F regimes. I'm just going to go out on a limb and say this is going to kind of defang the BEAT regime. The BEAT regime would also, to the extent there are payments made to non-CFC affiliates, it's really only going to apply to particular outbound payments that aren't subject to tax at least 15%. So this is, again, is kind of a material move away from how the existing regime operates, generally more in the tax favorable direction, particularly given the OECD's global minimum tax rules that have now been agreed to by many countries. It's anticipated that in the coming years, countries with rates under 15% that might actually trigger BEAT application are really going to start to become few and far between. So the takeaway here is just that the number of taxpayers that we expect to be subject to the BEAT regime, or maybe to say it better, that would have meaningful liability under these rules is going to fall off significantly. The next key item is the excise tax, and this one will be pretty quick to explain. It's basically a new tax that's going to be imposed on stock buybacks. It's generally going to be 1% of the value of the stock redeemed, and it's going to apply to all public companies. There will be certain exceptions for de minimis transactions and buybacks done in connection with comp or certain internal reorganizations. The key takeaway here, though, is that this will obviously increase the cost of buybacks, since this tax will be imposed at the corporate level, not at the shareholder level who's having stock redeemed out. So it's going to become more tax efficient, at least from the company's perspective, to return cash to shareholders via vanilla dividends. Okay, finally, well, not directly relevant to pharma companies per se, there's going to be some tax increases on high-income individuals, investors, and partners. So this will obviously matter more when it comes to dealings with your investors or sellers, particularly in the M&A context. While those headline, rate increases that were plastered all over the news in the early months, earlier this year as legislation was being proposed and winding its way through the process, pretty much all of those got dropped and aren't in this current package. But there were a few kind of, I'm going to call sneaky taxes that survived in there. And basically, there's some surtaxes on individuals with income over at least 10 million. That would take, that could take, if they both apply, their marginal federal tax rate for the affected individuals up to 45%. And this is just the federal tax rate, so state tax would be on top of that. There's also going to be a proposed expansion of the so-called Obamacare tax, so it's going to apply in a few contexts where it doesn't currently. So conversation about tax reform and the proposed U.S. tax changes is going to be incomplete without at least acknowledging that it's not just the U.S. tax landscape that's recently shifting and still shifting and maybe about to shift some more. There are a lot of changes happening concurrently outside of the U.S. For the last 5 to 6 years, the OECD has been really active in pushing tax reforms intended to limit earnings stripping and profit shifting to low tax countries. And in large part, those reforms have indeed been adopted by many OECD member countries, which obviously include most of Europe and many other developed economies. I feel like the EU in particular has been very proactive in implementing not only OECD reforms, but other directives kind of a similar ilk, including, so there are blacklist rules for tax haven and non-cooperative countries related to tax. And another big one, of course, that the EU will soon be making companies country by country tax reporting publicly available. I think, anyway, suffice it to say, the old playbook that worked 10 years ago or even 5 years ago is just no longer as effective or depending on the country, viable at all, maybe, in this new landscape. So this slide is just meant to highlight a handful of some of the key profit shifting types of rules that have been implemented outside of the US in recent years, and that need to be, factored into decisions involving any sort of cross-border transaction or structuring, as these have forced many taxpayers, including in the pharma sector, to really adjust course. Global minimum taxes. So there are also international tax reforms that can be broadly generalized as essentially countries trying to ensure that there's always some minimum amount of tax that gets paid on all income, or that every income, or excuse me, that every country is getting its fair share. And I put those in air quotes, not because I'm trying to make a policy position or anything here. This is the parlance that's being used, and these are the ideas that are driving a lot of these policies, policies that are slowly turning into laws. So in the EU, recent examples of reforms that I lump into this bucket include the introduction and strengthening of CFC regimes by EU member states. So essentially EU resident corporations having to pay some shareholder level tax with respect to income earned by, say, a subsidiary in a tax haven jurisdiction. Other countries have introduced kind of similar things like fairly aggressive anti-abuse rules, or general anti-avoidance rules, or what they're typically called, like in Australia, or the diverted profits tax in the UK. There's kind of a trend line here is what we're trying to point out. And the latest and arguably biggest development on this front is really the recent OECD agreement, with over 130 countries signing on this year to implement two new global regimes, or pillars. For some reason, they're being called pillars rather than rules or regimes. In a nutshell, Pillar 1 would amend transfer pricing and nexus rules so that a percentage of large multinationals' profits will be allocated to and then among countries where their consumers are located. Obviously, under current rules, these countries couldn't impose any tax on these companies unless they were to have offices or sufficient operations there, or some other agreed upon, usually physical connection with that country. Under these new rules, all of these countries will now be able to impose tax on a portion of the company's profits. So the affected companies that are within scope of these rules will be paying more tax, or tax in more countries than they do currently.
Mm-hmm.
Second big piece, Pillar 2, it's intended to ensure that large multinationals pay at least some minimum level of tax. This regime would have a few interlocking aspects. The key ones, though, would be first and primarily to apply what's basically a top-up tax at the corporate parent level for income earned by that company's subsidiaries, but taxed locally at a rate of less than 15%. Conceptually, this is very similar to the US's GILTI regime. There's also then a series of kind of secondary rules that will serve as backstops or supplemental rules. And this would allow countries to do things like deny deductions or impose withholding on payments that are being made to foreign affiliates that aren't or may not be subject to 15% or at least 15% tax. Ed alluded briefly to that. Pillar 2 now, though, is supposed to apply only to companies with annual revenues of at least 750 million euro. And Pillar 1 is supposed to apply only to companies with annual revenue of at least 20 billion and profits of at least 10%. But this takes me to my next and final and one of the most important points, and that is, as a practical matter, it's incredibly difficult to believe, or at least it's difficult for me to believe, maybe I'm being over skeptical here, but it's really difficult to believe that there will actually be universal, uniform implementation of these rules exactly as agreed to at the OECD, which is, of course, non-binding. it's not hard to imagine that different countries may adopt different thresholds as to which companies they view as being in scope. And it's anyway, it's going to be these gaps and disparities in implementation that may cause difficulties, particularly for U.S. companies and U.S. parented multinationals. And I'll finish off with this. It's an example, but gosh, it's just such low-hanging fruit. If Congress doesn't affirmatively change the U.S. rules and amend our existing treaties to conform to, or at least address these changes that other countries will inevitably be making, our transfer pricing and foreign tax credit rules simply won't work right, and they don't contemplate these new regimes. So there will be, with 100% certainty, disputes and double tax as a result.
Thanks, Lori. Thanks very much. I actually see that there was a question, and I'll briefly read it, answer it, and then we'll wrap things up. The question is, it's a good question. How do the GILTI rules impact situations where you're receiving payments as a licensor, but you're also paying payments because it's in licensed property? So let's say big pharma licenses in global rights, they pay up front. And then licenses it out to a third party. Pharma's income from the third party offset income to the pre-revenue company. The answer is, you would think it would, but it really depends on the character of each transaction. You could have remember one of the questions is it a license or is it a sale? You could have a license income, yet amortizable basis. It could be a sale and recovery of basis. So you need to actually model even that situation, which seems very straightforward. Because of the strange consequences of GILTI. And that's a good question because it kind of illustrates and wraps up, and this is a wrap-up opportunity. We could talk forever, and hopefully we appreciate your patience in the extra few minutes. I think kind of the takeaways are, for asset transactions, remember, your tax team is going to ask the 5 questions: partnership, sale, or license, etc. Consider the location of your IP. We've got a number of projects where some foreign subs are domesticating and other companies are sending their IP offshore. If you're negotiating a partnership JV agreement, watch the Senate proposal. All of the contingent rights and the milestones and the treatment of royalty sales that Ed described that are applicable, and the stock transactions with the NOL restriction rules. And then finally, Lori ran through a beautiful summary of some of the main principles that are going to apply to you. And frankly, in M&A stock deals, you got to watch, the limitation on the deductibility of interest expense. You might want to have the multinational push down debt to your foreign sub. The excise tax on the stock repurchase. Repurchase is a real broad, concept, and it might even apply to leverage buyouts. It could apply to transactions that you never would have expected. The GILTI tax, delaying amortization of R&D that will further affect the characterization of what your foreign ops are, and just watching what the OECD and the individual countries and Europe, and the ATAD, which is Europe, the restrictions that they're imposing is kind of a race to taxation before it was a race to alleviate taxation, and we're dealing on a daily basis with more avoidance of double taxation rather than minimization of taxes. And so keep your tax advisor close at hand. Thank you for your time, and we welcome any questions. We will be sending copies of the presentation, and it was a pleasure to spend the hour with you.